Well, good morning, everyone. It's 10 a.m. in the Eastern Time Zone. Appreciate everyone being here on time. Want to welcome you to the second quarter 2023 economic update and investment outlook. We appreciate you joining us today. We're having great participation, our usual diverse international group on our economic update. We have friends and clients on from Europe, from the Caribbean, and we welcome all of those from all over the country. Thank you so much for being here. We hope to give you a general overview of the key issues that are impacting the U.S. and global economies. We're focusing on the areas that will impact most of our attendees. Please note your questions in the chat box, and there will be ample opportunity in the latter part of the presentation to answer them. Several of you have submitted questions in advance. We appreciate that, and we'll address those as we begin our questions portion of the presentation or covered as part of the presentation. So let's review a quarter of continued adjustment, recovery, growth, change, and of course, good old uncertainty. We had our Q1 economic update 3 months ago. The U.S. economy was beginning to slow slightly. Inflation was slowing. We had unemployment continuing to hover at all-time lows. We were optimistic that the Fed rate adjustments would result in a soft landing. We're adjusting to the new norm. Americans continue to spend money on fun with family and friends, travel and entertainment, even if they are having to spend a lot more than they did pre-pandemic. But the pandemic period savings are starting to dwindle. It looks like student loan payments are about to resume. Rises in wages have cooled. Social Security recipients are spending briskly after getting the highest increase in Social Security benefits and rise in interest rates since 1981. So what does all this mean? Joining us today is Pat Gauthier, the Chief Investment Officer with CPS Investment Advisors. Pat, help us out.
Thanks, Marshall, and great to be here again with you. And breath of fresh air is a great way to put it after 2022. So significant market downturns last year. And it's nice to have a little bit of an upturn here this year as we'll dive into. So when we look at some of the market indices moving forward, we have the S&P, the Dow, and the NASDAQ all up dramatically here this year. So we have the NASDAQ up significantly, near 36%. We have the S&P following at close to 20, and then we have the Dow trying to make a run at it here as of late, up about 8.25 for the year. Even the bonds have gotten into the party here. We have the Bloomberg US aggregate eking out a 2% gain for the year in the face of continued rising interest rates. So interesting to note that the market in general, investable assets are typically gaining value here in 2023. So you may ask yourself, is that a surprise based on how we started the year and where we came from in 2022? Are we surprised to see that? And the answer is no. You'll note some of the downturns here and the intra-year declines indicated by the red dots. But typically when you see a downturn, particularly a significant one, the following year is a robust year for market returns. Outside of 2000 to 2002, which had some other factors involved, your down years are going to be followed by significant up years in the market, which is good for us as investors who are staying the course over the long term. We entered the year with recession predictions. Just about every economist and Fed watcher out there was saying, their interest rate hike cycle will cause a recession. Unemployment will rise, people will lose jobs, and they will spend less money. So let's see where we are along that recession path. A quick stop for Peter Lynch there, and just to note, a well-known investor, far more money has been lost by investors preparing for corrections than has been lost in corrections themselves. So that long-term play of sticking with high-quality investments is going to work out better for you. So here's a good way to look at what's happened so far this year. We've had inflation come down from highs. 2022 saw inflation rise 9% year over year, brought all the way down to just under 3% here in 2023. Now, what are people spending their money on? The core PCE price index is remaining a little more stubborn, but still off of highs from 2022. And then our core consumer price goods are still coming down as well. So that's notable for us consumers. Some of the things that were up dramatically in price are starting to level off and even come back to earth a little bit. Some believe the culprit, or at least you can partly explain the decrease in inflation to raising federal funds rates. So the Fed has implemented one of its steepest rate hike cycles in decades. And we've got the Fed funds rate now, as of yesterday, up to an upper limit of 5.5. So firmly in restrictive territory for the Fed, and has something to do with the idea that inflation is coming down from last year's highs. How about the job market? What has that done to unemployment rates? Well, it actually hasn't changed them at all. So good to note that there are many job openings out there for those seeking work. And for those looking to hire folks, it is still difficult to find the right people to come in and do some work for you. So if you're a job seeker, you are still in a very attractive market. And if you're looking for folks to come in and help you out, you're still going to pay a premium compared to years past. Historical unemployment rate, typically you're in the 4% range or even a little bit higher than that. So good to see that people are coming back to work in different parts of the labor force as well. And claims for unemployment insurance. Folks still have a lot of money in their pocket from COVID stimulus and pandemic area actions. So they simply just aren't applying for unemployment insurance at the rate that they have in previous post-recession. All positive notes on the employment side so far. And that's an interesting indicator to keep an eye on, because we know the economy is 70% driven by the consumer. So if folks start to lose their job at an increasing pace, you should start to see spending decrease as well. 2023 brought us a debt ceiling deal. So just to cover some of the ins and outs of that. So politicians agreed that the Treasury gets to borrow what it needs to cover its bills on time, and they'll postpone an actual debt ceiling until January of 2025. So interestingly enough, that coincides with some election cycles, and we'll be right back into negotiations on the debt limit in January 2025. So some of the key items here, you can debate the relevance of these, if you will. A lot of folks say the debt ceiling deal really had no teeth, but defense spending will remain in line with what the White House had proposed, and that next year's defense spending is going to revert to roughly 2022 levels, which essentially you can look at as a cut, because typically that will increase year over year. And then we have some rearranging of funds that were originally meant for the IRS, came from the Inflation Reduction Act. How they're reallocated and where they're pulled from, and the timing of that is up for debate. But essentially, those are some of the key highlights we came from a rather mundane debt ceiling deal, if you will. And then we're covering the mortgage rates, moving into what folks are seeing from the 30-year side. Folks just simply aren't buying homes at the same pace that they have in the past. If you have a mortgage rate under 4, which about 80% of existing mortgages are in that category, you're reluctant to go ahead and buy a new home at a higher price and a higher interest rate. Home affordability is down significantly from where it's been in years past. And that includes the refinancing side. Folks just simply aren't going to go out and borrow their home equity at 6-7+% interest. That's a little less attractive to do that than it has been in previous years, where you could get a home equity line at prime minus whatever the rate would be. So what's going on at the Fed? We had a meeting yesterday. They decided to raise rates by 1/4 point, and this is the dot plot of where they see rates going in the future. So the blue dots indicate the projection from the committee themselves, and the red dots are implied by the Fed funds future prices. So when you see those red dots there, a little bit lower than what the Fed thinks, there's a discrepancy between what the committee sees and what the market sees. So pretty consistent here for the end of 2023 as we are into the third quarter, start approaching the fourth. When you get out to 24 and 25, you see a little more dispersion. And that's just a little bit of uncertainty as to how strong the economy will remain and how high rates will have to go to tame that growth. The committee believes that by the end of 2024, the prevailing rate will be a little bit lower, and the market is starting to think that it's going to be even lower than that. But if you circled back to the beginning of 2023, you'd see a much different dot plot. You'd see rates down in the high 4s, and you'd see the market predicting 3s or even high 2s for the next coming years. So as economists will tend to do, we'll very easily adjust predictions and projections and kick the can down the road, if you will. So it's very easy to change our minds on this and not admit we were wrong on some of those projections. Interest rates themselves are interesting these days. We'll talk about this a lot in terms of asset allocation, but this is a snapshot of where yields are across the market. So you see those pretty nice yields on the short end of the treasury curve, which we'll touch on in a moment. But you can get a 3-month or 6-month treasury at 5.5, and if you roll it over for a full year, you'll get that 5 or 5.5% interest. And you can go out onto the corporate side and start to look at being in the high fours or close to 5 as well for high grade investment grade companies. And even when you get into the triple C's there, you're seeing a pretty significant yield in some of those areas of the bond market. Now, there was some uncertainty on the high yield aspect of things. Folks were anticipating an economic downturn, and those are the types of companies that tend to struggle when the economy slows down. But yet to come, again, economists are kicking that can down the road. But it's important to look at these yields as a measure of your ability to withstand fluctuations in the bond market. For a decade or so, you could go to a AAA corporate bond and really get no return. Treasuries were paying 50 basis points, if you will. So really not a lot of return in the bond market leading into 2022. But now we're reverting back to bonds being bonds, as I like to say. You can go ahead and lend to some high quality companies and lend to the US government and get a reasonable rate of return on your dollars. Bonds should start to act like a ballast in your portfolio again. So if you're an income investor, maybe you're living off your accumulated assets, it's a good idea to talk to your financial planner about how you can derive income from your portfolio without taking more risk than is necessary. And here's a look at the Treasury yield curve. A lot is talked about as far as the inverted yield curve and its recession predictions. Typically, you do find a recession coming at some point after a yield curve inverts. How quickly and how fast it reverts back to normal is up for debate, but we're looking at folks piling into these high yield, if you will, short-term treasuries versus going out on the long end. And a lot of that is just indicative of the market, assuming that growth and inflation is going to come back down to reasonable levels over the long term. And that's why those long-term fixed income instruments are not necessarily yielding higher than the short term at the moment. So when we zoom out, we take a 30,000 foot view and look at what we've been through in the markets over the last few years. It's important to take a long-term perspective, because if you focus on recent events going back to 2022, you can still feel a lot of fear in the market. I think if you look at your portfolio from the start of 2020 and where you are today versus where you started, you'll be pretty happy with where you ended up, even though it was a bit of a roller coaster along the way. As capital allocators, we look at our long-term plan and say, how can I allocate my dollars to reach my financial goals? We're not necessarily worried about beating any particular market over the long term. We want to understand what markets are doing for a reasonable baseline. But really, we want to look at the ability to have our assets grow in value with a proper amount of risk taken. And even with what we've been through COVID, through 2022 with significant downturns, and now coming towards the end of one of the steepest rate hiking cycles we've seen in a long time, you've still added value to your portfolio and still grown your wealth by sticking with your game plan. And we'll leave you with Warren Buffett here. It's always good to circle back to Uncle Warren. And the stock market is a device for transferring money from the impatient to the patient. And 2022 is certainly no different. If you were a seller in 2022, whoever bought your investments is feeling pretty good about them at this point. So patience is going to be key with just about any asset class over the long term. We love updating this year over year. It's one of our favorite slides, but we've brought in 2022 to the there's always a reason to not buy stocks scenario. So 2022 brought us oil price issues, an ongoing Ukraine crisis, which we don't quite have a resolution to yet. And as we mentioned, the steepest Fed tightening cycle we've seen in over 40 years. So I'm sure 2023, by the time we get to the end of it, we'll have some unique things to add this year as well. If you're picking up the newspaper still or turning on the TV or whatever social media you're following now, there's always going to be a reason that now is not a good time to buy stocks. But I would challenge you to look forward in 5-10 years from now. If we look back, we're going to probably bet, we wish we would have bought stocks or bought growth assets over the long term. So I will turn it back over to Marshall to share his thoughts, and I'll stick around to make sure we help answer any questions for you.
Thanks, Pat. As always, great job of getting us back in line and taking a hard look at what I'll call the reality out there. And a good look back. We'll talk more on a number of these subjects as we go through my portion of the economic update, but that'll get you started. And so let's look at some of the economic outlook for Q2 2023. As was noted, the inflation, it's still moderate, but at least it's trending downward. Our political tensions we'll talk about. Geopolitical tensions, they're still volatile, of course. We've got interest rates at the historically relatively low but higher levels. Unemployment still historically low, lots of jobs out there. Demand is still high but waning slightly. And the supply chains are nearing the pre-pandemic timeframes. But not just looking at what we see in the current picture, but let's look at what didn't happen last quarter. Number one, the U.S. did not default on its debt. A very important thing that we want to recognize. The U.S. dollar did not cease to be the world's currency. The Silicon Valley Bank failure did not trigger a banking crisis. Corporate earnings did not collapse. The U.S. economy did not fall into a recession. So what did happen? Well, Chairman Powell has been kind enough to tell us that there can be a soft landing achieved. As we know, unfortunately, most economists still don't think they can pull it off. But being the eternal optimist I am, let's agree to give them the benefit of doubt and hope that they do. Based on this morning's information, it appears they just might do it. You have to be careful because there are a number of experts out there telling us what's going on. For example, Michael Gapin, the chief U.S. economist at Bank of America, recently pushed back. He had called for a recession in the second half of 2023 to an even milder recession in 2024. He called it a growth recession. Sorry, I never learned what a growth recession is. I'm sure we're going to get to find out what that means in the future, but at the moment, I just don't quite know what that is. So Chairman Powell's definition of a soft landing, whatever you call it, we're headed to a short-term Fed funds rate increasing to 5.5. We're in that range. Unemployment rate staying less than 5%. We're still staying in the threes. Inflation less than 3%, we're right at that, and a positive GDP, not a recession. Well, whatever you call it, growth has slowed, which is generally a bad thing, but in this case, it's the goal of the Fed. The question is, what will growth or lack thereof be in the remainder of 2023 and beyond? Chairman Powell says there will be growth over a full year. There's increased forecasting of a slight recession that was moved from Q3 or Q4 in 2023 now to maybe 2024. Predicting a recession is a little like predicting rain. If you keep making the prediction long enough, it actually occurs. Well, yesterday, the Fed increased the Fed funds rate by another 25 basis points. In his statement, Chairman Powell left the door open for future hikes in the near term based on the evolving data received in the coming weeks. Kind of what I'll call a watchful eye approach. They've achieved the target rate of 5.25 to 5.5 of the Fed funds rate. So it's at least moving in the direction that was described months ago. Reported this morning, GDP was up, reflecting the Fed goal of no recession, but not as hot as 21 or 22. Consumers are the drivers. They spent on the refilled supply chains of vehicles, online purchases, and of course, dining and entertainment. The question still remains, what will happen this fall? Will these savings continue to decline? Student loan payments are scheduled to resume, and higher interest rates make financing cars, appliances, and other items less affordable. So while the economy has slowed, it's looking more like a soft landing than a crash. Inflation, as we see, have moderated. 7%, we're less than half of that for the second quarter of 2023. So it continues to statistically subside, but it sure doesn't seem like it at the grocery store or the gas station. Political tensions. Remember the debt ceiling crisis that Pat just alluded to? Both sides claimed victory. Marshall's opinion, the real winners were the pork recipients whose votes were purchased, and the losers were the American taxpayer. Trump and the other 12 declared Republicans are out there, and the debates start shortly. Biden and the other two declared candidates are out there, and their debates will start as well. And we're still unsure if we're going to have a third party candidate or not. But just think, there are only 467 days of campaign ads left until Election Day. Can't wait. Geopolitical tensions. Things haven't really changed much during the last quarter. The concept of a global economy has become more and more evident. The European dependency on Russian energy, Ukrainian wheat, and other products, coupled with the disruption of the Ukrainian production, is choking an already shaky Eurozone economy. The war in the Ukraine continues to escalate into just simply a proxy war between Russia and the financing from the West. China continues to support their neighbor Russia and threaten hostilities towards Taiwan. North Korea is a perpetual question mark, and OPEC continues to impact oil prices based on their production quota modifications. Free enterprise, if you will, but remember the U.S. being independent on oil. An interesting chart actually shows oil production by country. The top 10 countries with the highest oil production in barrels per day, and look who's number one. But then you add the OPEC countries in there, and we begin to dwindle. So OPEC still carries a strong influence in the oil prices around the world, and we've seen those skyrocket even within the last few weeks. And keep in mind, even though we are number one, we can sure consume. Looking at interest rates, near record high prices in the US have made it more difficult, of course, for first-time buyers because interest rates, quite honestly, have doubled since 2021. According to my realtor clients, the biggest hurdle is still supply. Can you imagine? As existing homeowners aren't willing to give up their 2.5% mortgages for a 6.5% mortgage. But the bidding wars seem to have subsided and the new home inventory is increasing. Demand for mortgage has fallen dramatically. Mortgage Bankers Association issued reports yesterday showing another decline in mortgage applications, kind of the bellwether indicator of what's happening. The pace of increases has just cooled off dramatically as rates have scared off sellers, buyers, and builders alike. Mortgage refinancing is all but non-existent. Rental demand is also drying up a little as high prices are pushing more people to consider doubling up or moving in with relatives. Unemployment rates, again, remaining steady now for 3 quarters. Nothing of substance in the unemployment numbers, but it does appear that the 25 to 54-year-old worker is returning to the workforce. You may remember there was a huge absenteeism in that demographic post-COVID and up to prior quarters. Consumer confidence is improving. U.S. consumers say they aren't feeling great about the economy, but they have a curious way of showing it. Pessimism about the economy is subsiding. Despite inflation's negative impact on purchasing power and sentiment, consumer spending growth continues to be remarkably resilient. Why is this happening? It's simple. Consumers still have money. However, as noted, these savings are rapidly declining amid the high inflation. The latest round of bank earnings shows apprehensions that still hasn't kept Americans from reaching for their credit card. I like follow Wharton professor Jeremy Siegel. He noted that many of these spenders are YOLO. That stands for you only live once consumers. They'll spend their last cash reserves on traveling and enjoying the summer. What happens in the fall is yet to be seen. However, as a follow-up to this, the July index came out at 117. Go figure. Leading economic indicators imply a cautious recovery. Ordinarily, this might be considered tepid news, seeing the leading indicators declining slightly. But with the Fed goal of slowing the economy, a slightly lower LEI is actually a good thing. So investing in uncertain times, we look at the history. Invariably, when you look at one of the red years, you can almost point and say, Fed raising interest rates. That was the case back in 1981. That was the case back in 2018. Obviously, we know that was the case in 2022. I think we all see a pattern here. But as we all know, it's different this time. And Pat was kind enough to go over some of those increases we've seen since 2020, in spite of what went on in 2022. And looking at the market recovery, I'm a big trends guy. And I look at this trend going back to the horrible 2008. So we've got about a 15-year program going on here, and look at the trend that continues. You'll notice the blue and the red lines. The corrections are declines of 10% or more, but less than 20, while minor ones are 5 to 10%, all in the blue shades. Bear markets are declines of 20% or more, the red shades, and the number of calendar days are there in parentheses. So it gives you some idea to go, yes, we've hit some bumps in the road, but the reality is the market seems resilient and continues to come back together. So what do we look for? In the words of Coach Bobby Bowden, we're getting near football season again. Sometimes it's best to just keep your head down and focus on blocking and tackling. So keep in mind, we're consistently besieged by worries about government deficits and debt ceilings, Federal Reserve policies, inflation and oil prices, in short, the irrational world that we live in. Yet publicly owned companies, which we patronize, sometimes daily, continue to prosper, growing their earnings and increasing their dividends. These have always been the eventual safe haven for investing for the long term. As has been widely publicized, there are a handful of technology stocks creating most of the returns. The Magnificent Seven are getting a lot of press. These companies are profitable and have a lot of free cash to flow to invest in research and development to tell us things we can't live without in the future. Growth is the icing investors look for. Keep in mind, small cap, mid cap, and value categories have also done well. Consumer discretionary and communication services are also outperforming the indices. Again, consumers have kept spending. Be cautious. It's the objective of the mainstream media to foster a culture of clickbait catastrophes, the development of an illusion that their existence as we know it is coming to an end. The U.S. economy is inherently fragile and unstable, and that the equity market may at any moment be subject to savage, long-lasting decline. Yet we know it is impossible to succeed as long-term investors without some fundamental level of faith in the future. The bottom line is stay tuned. Buy those companies, not the headlines. Be an investor for the long haul. Know what you own. Stick to your plan. Stay in that long-term lane. That's where the best rewards are historically. Avoid the emotional decisions that you read some press that this company is about to decline. I can tell you, if you search the internet, you can find on just about any company on any given day, there's somebody writing their decline and somebody writing they're getting ready to go off the charts the other way. So diversify, 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 and as Pat alluded to, use your walking around sense. I go back to one of the most successful fund managers in the world, a guy named Peter Lynch. Peter Lynch only averaged a 29.2% return per year when he managed the Fidelity Magellan Fund. Some of you may have invested or remembered it. In his 13 years as an asset manager, Peter turned the $18 million Fidelity Magellan Fund into a whopping $14 billion fund. Know your holdings and why they're in your portfolio. When I was preparing for today, I knew there was one topic that I had to talk about. The reason I had to talk about it is because you cannot pick up any publication, especially an investment publication, without seeing something about artificial intelligence. As hot as this topic has been, I just couldn't overlook it. I found an iShare for robotics and artificial intelligence, and I wanted to see what are the investments that the experts are looking at. Who are those key companies? I found that this particular one I looked at holds 112 companies with the largest holding a whopping 1.77%. The answer is, it's all over the board. AI is being developed in virtually every sector of the economy. Many of the companies are recent entrants, and many are old players whose names you would readily recognize. At the moment, it's anybody's game. But keep in mind, the old names have lots of cash to purchase promising developments and a demand network to introduce them to the market. Aspects of AI, like all technological advances, will ultimately impact our lives. In some cases, maybe dramatically, but specifically how is yet to be seen. Keep an eye out there. This is going to be strong coming at us in the future. So, what should you be doing with your financial plan? Well, not long ago, I came across some notes from my very first financial plan I prepared for a client. The year was 1976. The topics were exactly the same as they are today. They wanted financial independence and security for their families when they were living and when they are not. So sound economic and financial planning never goes out of style. Stick to the basics and tune out the noise. So if you have a question, please type it in the box. But Pat, I'm going to ask for your help here because some of these are really your strengths. Uh,
Happy to help.
yeah, you had a slide on a couple of minutes ago, or a few minutes ago now, on interest rates by type of investment. So I got to ask, in the current rate in interest rate environment, should I load up my money market and earn the current 5% or 5 plus percent yield? What's your thought on that?
That's a great and a very popular question these days. So it is attractive compared to where we've come from for money market yields to hang on to cash. You're getting 5%. That was unheard of just 18 months ago. But I revert to the planning, and I'll dive into this a little bit. Cash is a tool that is used in your financial plan, and really it should be a part of, although a very small part of your investment plan. So cash is a holding place in between investments. It's where you accumulate your dividends and your proceeds from sales. But don't think of it as an investment, but think of it as a temporary stopping point in between your investments. So if you have some savings set aside for emergencies and that's part of your financial plan, then rest assured you're taking advantage of cash rates by hanging on to those financial planning aspects. But from an investment standpoint, you're taking some additional risk by not investing at the moment. We can get into reinvestment risk if you wish, but ultimately, those money market rates, as fast as they went up with Fed rates increasing, they can go down just as fast once the market turns and the Fed starts to cut interest rates.
Great points. I appreciate that. Yeah, it's fun while it lasts, I guess is a good way to describe that. So one more for you, Pat, and give me the crystal ball. Where will the market finish in 2023? We've heard Chairman Powell. Let's hear from Chairman Patrick.
Oh man. So I'll try to dust off the crystal ball. It hasn't worked well lately, but typically, given where we've come from at the start of 2023, you wouldn't expect, a continued run up in stock prices. But ultimately, if I had to put a prediction on it, I'd say expect a bumpy road into the end of 2023. While there's still some uncertainties that'll settle through the market, we're getting a little bit of more broad upturns in the market. We mentioned the Magnificent Seven earlier, and that is really what dragged indices higher throughout the year. But I wouldn't expect that rate of increase to continue, although you'd have to have some pretty dramatic events happen to have it come all the way back down to where we started. So my best explanation for the rest of 2023 is a little bit of volatility and hopefully some clarity on where rates are going to be into 2024.
Thank you. You may note in the chat box, my fellow advisor and good friend Jay Gregg has posted for everyone, cash is not an investment. As Pat alluded to, it's a holdings place for your temporary funds. You have to look other places for investment, which raises one of the questions that was sent to us earlier, and that's the thought of looking at bonds as an investment for capital gain in the coming years. For years now, we have taken a very short term, short duration look at our fixed income investments because we anticipated interest rates rising. Now that it appears in the coming years that interest rates will decline, and Pat gave us the Fed's look at that and the markets look at that, does it make sense to buy bonds at their current rates in anticipation that when the rates decline, their value will go up. But looking at those yield curves, the market hasn't really raised the rates that tremendously, and the downturn over the next 2 to 3 years doesn't look like it'll be rapid enough to make that a sensible alternative. So I would say be cautious in that. It's not like the days when we had 10 and 12% bonds out in the long term and we had the fluctuations on those down to virtually zero. It was really interesting being an advisor for a number of years with clients when interest rates were 25 basis points, 50 basis points, and you're looking going, if you had to guess which way interest rates were going, up or down, it was pretty easy. There was nowhere to go down, so you pretty much had to assume they were going up. So things for you to think about. One item of clarity, the young lady you see on the screen is not Pat. It's my granddaughter, London. So I didn't want people to think that Pat was that good looking. Sorry, Pat. I have to be honest. Full disclosure. Speaking of
The truth
disclosure,
hurts
there's our
sometimes.
disclosures. At any rate, our next scheduled event will be our third quarter economic update, which will be held Thursday, October 26th at 10 a.m. I'm sure it will be interesting. I thank you so much for joining us, and I look forward to meeting you soon.